Hello, good afternoon everyone. Today we are going to discuss about insurance law. Before that, I am going to introduce myself. I am Greeshma, Assistant Professor, Department of Commerce and Management Studies, Amal College. So let's move on to our slides. The insurance laws. There are various laws associated with insurance. So we are going to discuss about various laws associated with insurance, that is particularly life insurance. Before going to the life insurance, let's discuss about the history or evolution of insurance. Insurance starts as a marine insurance and which initially originated in China, where they use different ships to share the risk. That is, for different ships are used for a same cargo, so that the cargoes are disposed in various ships so that the risk has to be minimum. And again, in 4500 years ago in Babylonia, traders bear the risk of cargo trading. And they also have the Code of Hammurabi, which granted the legal status to the insurance, that is mainly marine insurance. They formalized the concept of bottomry, which is the vessel bottoms, and respidentia, which is cargo. And in marine insurance, there should be three elements according to Code of Hammurabi, that is a loan on the vessel or the cargo or shipment, or an interest rate and a surcharge to cover the possibility of loss. Now, the present form of marine insurance came from Belgians. Now, the fire insurance. Next category is fire insurance, which initially originated from Germany in 16th century. The first regular office for the fire insurance started in 1968, and in 1732, first fire insurance company established in US. Also, in the case of life insurance, burial insurance is the first form, where burial clubs come up an idea which provide financial assistance to its members for burials. And again, in insurance in India, which is an ancient form, and according to texts, Aryans used the concept of insurance in 10,000 BC. And next is the modern insurance. The modern insurance originated in 17th century in England, where Lloyd's coffee houses, where merchants, ship owners and underwriters met to discuss business deals and transactions. They also have a gambling on life and death of people, which later discontinued. Now let's move on to life insurance. What is life insurance? Life insurance means insures the insured against a happening of certain event. The first society which sold life insurance was Amicable Society for Perpetual Assurance Office. And later in US, the first insurance company in 1732 was formed in Charleston, South California. There were similar societies which offer life insurance, like as the Presbyterian synods and the Episcopalian priests, which use funds for weaker sections of the society. Then prior to American Civil War, there were life insurance or life insurance coverage for the slaves for their owners. So companies insure the slaves for their owners. And in insurance in India was usually divided into three phases, that is pre-nationalization, nationalization and post-nationalization. Before nationalization, there were a number of insurance companies which usually target the British and there were discrimination against the Indians and the British. And later, after the independence, Indian government introduced various reforms, and the first one was the nationalization of LIC, which happened in 1956 by consolidating operations of various insurance companies. Later, General Insurance also followed the same pattern, and General Insurance Corporation of India was formed and nationalized in 1973, which have the subsidiaries known as New India Assurance, United India Assurance, and National and Oriental Assurance companies, which you have already known. Then later come the economic liberalization. Based on the economic liberalization, the government felt that there is a need for an authority to look after the insurance industry. So a committee was formed to look after and study the insurance, and a Malhotra committee was formed, and they given a report in 1994. According to their report, IRDA was formed in 1999 through an act, IRDA Act. Based on the act, insurance sector is open to the private sectors, and various private insurance companies start operations from 2001 onwards. Now, life insurance. In life insurance, the subject matter is human beings. We insure ourselves for the contingencies we face. So it is not a normal contract, it is a contingent contract, because we can't value the life of a person in monetary terms. That is why it is a contingent contract. And according to Section 2 of Indian Insurance Act, the life insurance is defined as a business of effecting contract upon human life. It is a contract which affects human life. So we are actually contracting for the safety of human life in monetary terms. So life insurance is a contract. So there should be two parties, and the contract should be a mutual agreement. So life insurance is a mutual agreement by which one party agrees to pay the another party. One party agrees to pay the another party for a given sum. Given sum upon happening a particular event. Upon happening a particular event in a human life. So the party should be paid a sum to the insured, and the insured should pay a minimum amount of sum to the insurance company that we call as premium. I hope you are all aware of the insurance premium. So in short, life insurance is a contract whereby the insurer, in consideration for a premium, undertakes to pay certain sum of money either on the death of the insured or on the expiry of a fixed period. Usually, once we take an insurance premium for a life insurance, there should be a termination date. The termination condition should be either the death or a fixed period. So the amount we invest in the insurance, we get it back once either of these conditions met, which are happened earlier. Now, let's move on to the features. What are the features? We said that agreement, life insurance is a contract, an agreement between two parties. So the features are the features of agreement or a contract. The first feature is the outcome of offer and acceptance. The insurance party should give an offer and the other party accept the offer. Only then the proposal become an insurance. So it should have an offer and an acceptance. And the insurance company agree to pay the certain amount on happening of a certain event. And insured has the obligation to pay the premium. That will be a small amount. It should be paid periodically till the death or till the period through which insurance is covered. And it is not a contract of indemnity. Why it is not a contract of indemnity? That is because we cannot monetize the life of a person. And the insurable interest must be present at the time of taking. What is insurable interest? That whatever we take on will have an interest. That is, we have interest in our own life. It is so valuable to us, and we have interest in our dependent, our parents, our business partners, our creditors, our children, our sisters. So we have an insurable interest. So an insurance must be taken when there is an insurable interest, at least at the time of taking insurance. And some people are also considered as an alternative way of saving, and they use insurance for tax benefits. Now, why insurance is important? So it gives a kind of protection for untimely death. So the insured get a secure feeling that the family, relatives, their dependents get some monetary benefits if something happens to them. So that kind of feeling attracts people to take life insurance. And some people take it as a savings for old age, and it's a promote savings, and it's a method of investing. So companies usually what they do with this huge amount is they invest in various securities. The small premium that we give to the companies, the insurance companies invest these amount in various securities. So it is an investment options. So it initiate investment, and it's a social security. As I told, insurance have tax benefits and tax deduction. And another is credit worthiness. If you have an LIC premium or any kind of insurance, you can get loan based on these securities. So it is credit worthiness. And now let's move on to the laws relating to life insurance. There is mainly 3 laws relating to life insurance. The first one is Insurance Act of 1938, which is the basic for the all insurance laws in India. The basic rules or law is Insurance Act of 1938, which is introduced by the British government. In 1938, it covers various provisions related to all aspects of insurance like fire insurance, general insurance, life insurance, marine insurance, or any kind of insurance which was present at the time of 1938. All the provisions related to these insurance are covered in this law. And it contains provisions regarding to insurance agent also. They cover various provisions and they protect the insurance holders' interest, policy holders' interest. And they also have the provision for limits on expenses of the insurance and how these insurance funds should be invested in various securities so that the risk of these insurance holders should be minimum, so that the insurance holders get maximum benefit from their insurance investment. And based on this act, a controller of insurance was set up, and they are responsible for the administration and maintenance of the Insurance Act, controller of insurance. Then later, this controller of insurance post was replaced by IRDA in 1999. Now, let's move on to the Life Insurance Corporation of India Act 1956. Life Insurance Corporation was nationalized in 1956. So it nationalized through this act, Life Insurance Corporation of Act 1956. So before nationalization, there were a number of insurance companies which mainly focused on British Indians, and there were discrimination against Indians. And government thought they need to control and regulate these insurance companies. So what they did was they nationalized. They acquired all the insurance players in the market, and the Life Insurance Act came in January 19th, 1956. At the time of this act, there were around 230 to 43 insurance companies and 25 provident societies and 16 non-Indian insurance operating in India. All these companies were taken over by Government of India. Then comes the Insurance Regulatory Development Authority Act, IRDA. IRDA is the regulating authority of insurance business. Till 1999, there is only one insurance company in life insurance and general insurance, that was LIC in life insurance and GIC and its subsidiaries in general insurance. So there was a monopoly of LIC, and there was economic liberalization, and government want to introduce more private players into the insurance industry. So they introduced a method to incorporate private players into the industry. They set up IRDA. They regulate the insurance industry, and they provide, and this act provide for the establishment of authority to protect the interest of both the policy holders and the private players, and they issue various regulations so that the insurance industry grow. Now, what are the general principles in life insurance? The general principles is similar to the principles of a contract, that is, it should have an offer and an acceptance, and there should be a legal relationship. Once we are coming to an insurance policy, we are creating a legal relationship between the insurance company and ourselves, and there should be a consensus added up that both parties should make a conclusion or consents, so that there is no further difficulties or contradictions in the terms and conditions. And next is the competency of parties. That is, for a contract to be valid, the competency of parties is necessary. That should be, it is a huge list. What are the competency conditions which will be covered in contract? So next is the free consent, that is, both parties should come into a conclusion or agreement without any further pressure, and it should be for a lawful consideration, and it's a legal object. So now the basic principles of insurance contract. There are two principles: principles of utmost good faith and principles of insurable interest. Principles of utmost good faith says that there should be no blocking, or the material facts should be disclosed by both parties. That is why when we look for an insurance policy, there are huge number of terms and conditions that we often forgot to read, and the company also require us to disclose all the required material fact correctly. That is what in principles of utmost good faith. Next is the principles of insurable interest, that we insure for an insurable interest, that what we value in our life, that what we insure, and our insurable interest will be our own life, maybe our others' life, And insurable interest of our own life, we insure for ourselves or we insure for the rest or our dependent like parent and child, husband and wife, brother and sister, and for creditors and for business relationship. And now the terms in insurance. First is a proposal and a policy. What is proposal? Life insurance or company offers a policy on the basis of a proposal, that we write what our requirements, we write our material facts, they evaluate these facts, and then according to these facts they give a policy. So that is the proposal and policy. So proposal is basically a form which seek basic information of a proposal like name, date of birth, age, and any other material facts. Form. And the proposer can attach another sheet of paper if he like to disclose any other fact which is not required by the form, but if he wish to disclose anything, he can attach it with it sheet of paper. And the life insurance agents we call in technical term as life insurance underwriters. They use this information regarding the proposal and they send it to the company. The company evaluate all these form and data, and the company give a photocopy of the proposal to ourselves to verify the details we given to them. Photocopy of the proposal along with the insurance policy document. If we have to get the insurance policy document, the primary condition is we should pay the insurance premium. Without the premium, the company won't give the insurance policy. Now, what is insurance policy? Insurance policy is a certificate what we get once we pay the premium. It is a certificate of contract of insurance. It have the terms and conditions and various premium, deductibles, all the details, term, coverage, premium, etc. All the details should be included in the policy. And it is a legally binding contract also. And now, if you are taking a policy for ourselves, if something happened to us, we like to or we wish to give the amount or we wish to get the amount to our relatives, that what we call nomination. So nominee is the person who is entitled to receive the amount if something happened to us or the policy holder. And nomination is the process of giving the right to the dependents. So once we are giving the nomination, we should give details about them like their name, age, address, and the relationship between nominee and ourselves or the policy holder. And there is assignment in policy also. Assignment means transfer of right. We are giving all right regarding the insurance to another person. So there is various type of assignment like conditional assignment and absolute assignment. In conditional assignment, the assignee get the right of the policy. If something happens or a specific event happens, the assignment is revoked or suspended. And in absolute assignment, there is no absolute revoking. So that is absolute assignment, there is no revoke. And the assignee acquire the complete right. And now come the last, title and claim. Claim is the payment we receive once something happens, either if something happened to the policy holder or at the end of the period. So, claim is the payment made by the insurer to the insured. So, there should be, I told about the condition, either in case of an event or at the end of the maturity period. If something happens, or in case of death claims, we have to submit proof of death, proof of title, age proof, and in case of nomination, nominee details, etc., etc. And in the case of maturity, proof of title and age is enough. And different type of death require different documents for verification. And if the maturity is the condition, then maturity claim should be sent to the company before the completion of maturity, so that the payment can be made is at the time of maturity, and the claim settlement should be within 30 days. That is the basic overview of insurance and life insurance contract acts and etc. With this we conclude. Thank you.